Hello, this is Joe Slezak, Director of Marketing and Business Development for H2R CPA. Thank you for joining us today. The Q&A session will occur at the end of the presentation. We have tried to answer as many of the pre-submitted questions as possible during the presentation portion of this webinar. Please use the chat feature to submit your questions, which can only be seen by me. Please note, since this presentation is being recorded, specific questions which contain identifying information will be filtered to protect our audience. I will now turn over the presentation to Kieran OD. Thank you.
Thanks, Joe. Good morning, everyone. First, I'd like to say we appreciate everyone taking the time this morning. I hope you're all staying safe, sane, and somewhat productive during these times. I'd like to thank Joe for helping us put these presentations together. Over the past several weeks, we've done some of these webinars to help answer questions that our clients and colleagues have. You'll notice today that we are doing the webinar with audio only. After 6 to 8 weeks of salon closures, I think it was best for everyone that we're not showing faces today. I think people are having a little bit of webinar fatigue as well. So thanks again for joining us. We'd like to spend some time today talking about what we're seeing in the M&A markets and have assembled a nice panel of experts to talk about how the current pandemic might impact valuations, what we might see in the market, what it's doing to change diligence processes, and generally the M&A timeline right now with companies not being able to do a lot of face-to-face interaction. So as we all know, the M&A markets have been very robust for the last decade, and we've been wondering when the time was going to come where things were going to change. And I think this has obviously changed the way some businesses are valued and changed the process in general. So I'd like to thank our panel today. First, to introduce myself for those that don't know me, my name is Kieran OD. I'm a partner with H2R CPA. 25 years experience in public accounting, mostly doing audit work, a lot of M&A work. I was formerly the head of a transaction advisory practice for a national firm. Steve Dotterer is a senior manager with H2R CPA. Steve focuses primarily in the business valuation and litigation support practice. So Steve's going to help us understand the valuation market. Dale Killmeyer with Pier Capital. I don't want to give Dale's age away, but he's got 30 plus years of experience helping serve middle market companies. Dale's had internal and external roles, both as a CFO and as a consultant, doing capital raise, deal structuring, diligence advisory. Our final panelist today is Dan Sarver from Confluence Advisors. Dan has 25 plus years of corporate finance and M&A experience. Him and his group deal with a lot of buy-side and sell-side consulting and capital restructuring. So I'd like to thank our panel again participating today. And I'd like to start the discussion by turning it over to Steve Dotterer. Steve's going to give us a quick high-level overview of the last 30 years of M&A activity so we can look at it, in a historical context to kind of frame today's discussion. So Steve, take it away.
Thanks, Kieran. Good morning, everybody. Thanks for joining us. To echo Kieran, I hope everybody is staying safe and sane. Again, I'm Steve Dotterer. I'm the Senior Manager of Business Valuation at H2R. I got my MBA in finance at Carnegie Mellon's Tepper School of Business and my JD at the University of Pittsburgh School of Law in 2013. I thought I'd kick today's webinar off by discussing the last 30 years, the economy, and how our current situation shows some similarities and differences to those situations. I'd be remiss if I didn't mention that the U.S. jobs report just came out, and unfortunately, we're seeing a U.S. unemployment rate of 14.7%. That's 20.5 million jobs lost. So that's not a great indicator going forward, but we will be able to recover. So to start this thing off, you've probably heard of the various alphabet soup terminology for economic recovery curves. One curve is called the V. It's essentially the quick bounce. The economy goes down, there's an inflection point, it goes back up. There's a U shape, that's the slow recovery curve. There's an L shape, and that's sort of a drop off, and then it doesn't recover. An example of that might be a cruise line business currently. some of those businesses are not expected to recover. A W-shaped curve is sort of called the double dip recovery. And I think we're going to see some elements of the W-shaped curve in our current situation. There are also some others that people like Jim Cramer have come up with, like the J curve, but we'd spend the rest of the webinar talking about that if we went through all the permutations. The point is that there have been 3 U.S. economic recessions since 1990. As you know, the general economist definition of a recession is 2 consecutive quarters of negative GDP growth. First recession was in the early 90s, stemming from the oil price shock, the Gulf War, and other factors. The early 2000s, of course, we saw the dot-com bubble and the 9/11 attacks. And in 2007, 2008, we saw the subprime mortgage crisis. So now we fast forward to 2019, 2020, we find ourselves in the midst of this economic and public health crisis from COVID-19. So the natural question that we're seeing right now from business owners and advisors is, how will this affect the value of my business? Can I still retire as planned? What can I hope for going forward? So I like to answer this question by starting with the 3 main methods of valuation: the income, asset, and market approaches. Probably the most intuitive way to value a business is the multiples-based approach. And I like to think of this as a hybrid of the income and the market-based approach. It relies on a base multiple, such as EBITDA or EBIT, and the synthesis of completed market transactions. And it arrives at a price according to a number of turns of that base multiple. And we're going to hear a lot about the multiples that we're seeing in the market. But I'd argue that the income approach is one that we really need to consider in this environment. I've been talking to a lot of advisors and observers, and there have been a lot of advocates of a probability-weighted discounted cash flow. And the strength of that is the feasibility of determining a range of outcomes and developing projections that sort of probabilistically weight possible outcomes. However, the problem with these models is that the output is only as good as the inputs. Are we all epidemiologists? Are we able to determine what the cash flows will actually be? Even if we address it through a discount rate or a cap rate, there are also assumptions implicit in that. So there are a lot of different levels of assumptions that have to go into this. Additionally, as a business owner, you may be using the PPP program. So if you did receive the PPP funds, are these funds going to be forgivable? Will it affect your tax rate? All of these things are elements that need to go into evaluation to determine what the value is as of a particular date. Other qualitative factors would be the quality of the management, your ability to retain customers, and the quality of the balance sheet. On the subject of the balance sheet, the asset approach is an interesting question. We got some questions submitted on possible distressed assets and how that would be affected. I know that there are some PE groups out there that have dry powder available to purchase assets, and there may be some marketability discounts to some assets out there. So there may be a buy opportunity for some financial buyers. So the question that I have is, how is COVID-19 different than these 3 recessions I mentioned and other economic crises we've experienced? And the difference seems to be the effect on both the supply and demand side of the curve. Not only have supply chains been impacted, but consumers have also been affected. I just quoted the 14.7% unemployment rate as indicative of that. And this crisis presents us with a unique challenge of unemployment, low interest rates, negative spot oil prices, and sort of news cycle dependent daily market fluctuations. So with this framework in mind, I'd like to hand it back to Joe to moderate the discussion with Dan and Dale and identify the deal flow and some of the multiples they're seeing in the environment.
Thank you, Steve. And thank you for the background you provided. That's very valuable to help set the foundation for the conversation to come. And with that, continuing that line of thought of setting the foundation, we want to touch upon the deal flow and the sectors and the multiples before the pandemic, just to provide some insight before we dive into the current environment. And so to start, I'm going to actually ask Dan to maybe kick it off and provide some insight in regard to what he was seeing before the pandemic.
Yes, thank you, Joe. This is Dan Sarver from Confluence Advisors. At Confluence, as was pointed out, we primarily do sell-side advisory and capital raise. And as I would say, coming into 2020, very, very strong M&A market. And I think most people were predicting that to continue strong throughout the year. Capital was plentiful, interest rates were low, ROI requirements had become lower, which all these factors have been driving up purchase price multiples higher. So for example, at Confluence, we sold 4 businesses over the last couple of years for over 10 times multiple of EBITDA, and probably in the previous 8, we had sold perhaps 1 business. We had a very strong backlog coming into 2020, sell-side engagements, but we were cautiously optimistic coming into 2020 because in the back of our minds, we knew we'd been in this prolonged economic expansion and something sooner or later was going to happen that was going to push us the other way. Didn't know when and didn't know what it would be. We thought something would happen. I mean, we could never imagine it would be COVID. So that's really put a damper on the M&A market, as you can imagine. As far as hot sectors, every industry we were seeing deals getting done in. We get inbound calls daily from private equity firms and strategic buyers asking us what's in our pipeline, and we're talking to them and asking them what they're seeing in the market. I would say at the time, hot businesses or hot sectors, tech-enabled businesses, SaaS businesses, software products, businesses that touched aerospace along the supply chain, and that has really changed today. Specialty chemicals were hot, testing, whether it's products, food, infrastructure, or chemical, healthcare, IT, products and services, and outsourced business service companies. Those were just a few examples of hot sectors. In addition to that, any business that had a recurring revenue business model, they were highly sought after. Any business that had engineered or branded products or proprietary products were sought after. And just to give you a gauge of multiples, we subscribe to different services that provide us with average purchase price multiples for businesses. And on average of businesses valued between 10 and 250 million, it was 7.1 times in 2019. Now, larger companies would garner a higher multiple. So the larger companies were closer to 9 or 10 times, and the smaller companies were still almost 6 times. So that just gives you an idea of where multiples had been, and they've been at all-time highs.
And Dale, based on Dan's comments, anything you could add to that piece?
I think Dan's recap of the market up until COVID is accurate, and I think post-COVID everything has changed. Right? We all have a new moniker to use. Instead of EBITDA, we now have EBITDAC. Right? Earnings before interest, taxes, depreciation, amortization, and COVID. So if an ownership group needs to sell in 2020, there will be add backs for the normal add backs that you normally have, and then there will be add backs for COVID. When you talk to private equity groups and other sophisticated sources of capital, there's so much uncertainty in the market that it's hard unless they already know the potential target or they are experts in a certain area, which is common in private equity groups. The rate of deals going forward is going to decline dramatically through the balance of 2020. And those deals that will get done will be in certain sectors. We'll say favorable deals that get done are going to be in favorable sectors like IT services, certain healthcare related suppliers or technologies, and other industries. If there needs to be a deal, maybe just because of financial necessity, then we all understand the valuation of those enterprises is less today than it was in December of 2019.
Thanks, Dale. And I know you touched upon it briefly there with the comment you just made. And I know we even received a couple comments on international, and just so the audience knows, we did talk to a number of people, and the international component, it's a little complicated right now. I think from our standpoint, a lot of us are still trying to understand the domestic market. So in that regards, and Dale and Dan can definitely add insight. They're assuming the same situations occurring domestically are occurring at the international level, but there's so many moving parts. It's hard to tell what's occurring across the globe at this time. But Dale, kind of kicking it back to you, you referenced lower deals, prior comment. Can we expect lower multiples as well upcoming?
Sure. Valuation multiples have gone down because of the uncertainty in projecting future cash flows. When it all comes down to it, the market, sophisticated capital, is looking to purchase future cash flows, future revenue, future earnings, right? So it's now in most industries, not all, but in most industries, there's a lot more uncertainty, and that's going to impact the valuations. We also understand and recognize that as valuations increased into record levels in 18 and 19, the banks were anxious to participate. And so closing a deal at 4 times EBITDA debt levels was not unheard of in that period. Banks are going to be a lot more selective. The bankers that we talk to initially have just been focused on PPP loans, and everybody rolled up their sleeves and jumped into that to help out the bank and help out their customers. Most bankers we talk to, if it's a new credit facility or a new transaction, it's going to have to be the best of the best, right? Every banker wants a good credit with strong revenue, et cetera. So banks are going to be a lot more selective in going forward. Plus, the bankers are focused on quote unquote saving their portfolio and their current customers. So credit will be less readily available than it was in 2019. It'll be more selective, and the covenants and the terms and conditions will be tighter.
Dan, is there anything you can add to that piece?
No, I think Dale's exactly right. I think the valuation multiples in general will be lower as they're impacted by just the quality of the company itself, the availability and the amount of credit, and the visibility of the cash flows or lack of visibility. I've been talking to some PE partners over the last several days. I think that quality deals will still somewhat hold their value, as there's going to be a rush to quality, given that there's a lot of dry powder out there, and still want to find homes. So you might see maybe a turn lower of EBITDA. So I think a strong company, a strong deal in the market will hold relative value. But I think what's going to be more important, and Dale touched on this, is the structure is going to be impacted more. There'll be less equity that buyers can obtain to fund a transaction, and therefore they're going to have to put more equity in. And if they still require the same return on investment, then in order for them to keep that same return on investment, they're going to have to pay a lower valuation for the company as they put more equity in. Now, I think it's going to come down to the companies out in the market, what type of visibility they have, and can they demonstrate growth in this uncertain environment? And people are going to price it based off of those factors.
Steve, both Dan and Dale mentioned a number of valuations, and following that theme, and you touch upon it briefly, are there other methodologies or alternative valuation methods that may be considered moving forward?
Yeah, thanks, Joe. So Dan and Dale are exactly right. The industry in which your business operates is going to be critical. If you're talking about a physician practice being bought by, say, a hospital system versus a machine shop being bought by a larger OEM, the valuations of those two industries are going to be fundamentally different. And sort of what it comes back to from a valuation perspective is, what is the present value of the future cash flows? Does your business have access to customers and the correct markets? And in this environment, does your business have the ability to weather this climate? Additionally, when you talk about alternative valuation methods, Dan and Dale touched on a couple mechanisms that can be used to create a deal. And a lot of that has to do with the buyer and the seller's respective risk tolerances. So, for instance, would a business owner consider a locked box pricing mechanism? And that essentially means the final purchase price is fixed and based on the financials as of a set date. Or are you willing to entertain an earnout? You know, if you have an earnout valuation for your business, then you can potentially share the risk between the buyer and the seller. But again, it comes back to that point of, are we epidemiologists? Can we do correct projections? But in the case of an earnout, at least you can have some risk sharing. And there are a couple other options that I at least wanted to mention. And one of those is the employee stock ownership plan, or ESOP. I know we have a couple people on the line who are very well versed in those areas, and that might be something to consider as a business owner. Another way to consider exiting your business potentially is through gifts, and we can talk a little bit about that down the line, but a gift is going to be valued at fair market value, and in this situation, a lower valuation is actually beneficial from a gift tax standpoint. So there are a lot of different things in play here, and it sort of depends on whether your business is looking to sell as part of a strategic transaction with a financial buyer, or you're looking to go through succession planning through, say, an ESOP or a gift, or you're just looking to unload and maybe convert some debt to equity. So I think that those are some different factors to consider.
You know, this current environment, we received a number of questions in regard to what may change in the due diligence process. Can it be done remote, supply chain interruptions, things of that nature? Dan, you know, can you provide some insight on maybe what you've seen?
Yes, and this is based on, experience, live experience. We have a deal that was signed under a letter of intent, and because the restrictions on whether it's travel restrictions or that shutdowns of plants, it has caused the due diligence process to be slowed. However, much of the due diligence can be done virtually. There still needs to be on-site visits. People are not going to buy a company without taking a look at it. They want to visit the facility, assess the equipment, the condition of the building. They want to meet face to face with the employees, because they're and key employees. They're making an investment in the people as much as the business. And also, in many cases, buyers hire third-party due diligence providers to perform critical due diligence functions, including quality of earnings, environmental due diligence, and sometimes they want appraisals on the equipment and buildings. Those groups need access to the facility to do that, and if they can't get in there, that just slows everything down. If debt financing is needed, in a particular bank financing, they're going to require a field exam, and the field examiners need to be on site. So there's a lot that can be done virtually, but ultimately there's things that groups have to do to perform their due diligence that needs to be on site. So what we're seeing is, when typically you sign a letter of intent, you might give 60 to 90-day exclusivity. We think, we just signed a letter of intent, we had to give 120 days. We gave longer exclusivity because they're still moving forward, want to do the deal, but they just know it's going to take longer because of limitations on site access.
Kieran, as a business owner, you have the history of coming in from the buyer side in a Q&E perspective. Could you maybe provide some insight of what you think a business owner could do to maybe help protect themselves in regard to the due diligence process?
Sure. I echo a lot of what Dan said. I think the process right now, depending where you were on your timeline before this happened, your process was affected differently. We helped somebody close a deal a couple weeks ago, but they were so far along through the process, we were just helping with some QOV work and getting some last minute things they needed to check the boxes on their financing. So that deal was pretty well far along, and they were able to close it in spite of this because they had already done that. I think if you're early on in the deal cycle, like Dan said, you can't have management visits and things like that. It's a little harder to progress So depending on where you are in the cycle, will affect the outcome currently. But I think in the future, the things to look for are, as we evaluate these businesses, we generally try to look for blind spots. So this is a good time to identify what the blind spots were in your business. Some of them are on the screen. Did you have any supply chain interruptions? I would add to that very significantly now, more so than in the past, would be labor interruptions. That's something that we would consider in diligence if you had a union or some other things, or what your labor force looked like. But based on the current environment, the ability of your labor force to actually work together, like if you had a call center with a lot of people on top of each other, that's obviously even if the governor opened those kind of building businesses up right now, they're going to have to change the way they do things in terms of social distancing and spacing. So I think, as a business owner, I would take the same steps I would in the past, but I think this gives you the opportunity to look deeper into your business, understand where those blind spots were. I think from an external diligence perspective, we'll be asked to look more at customer and vendor concentrations and those type of issues in the future, looking up and down your supply chain to see what type of businesses were really impacted by something like this. And if something like this were to happen in the future, what that could do to your supply chain as well as your customer base, understanding who your customers are and what markets that they play in and what effects that could have for them. So, unfortunately, in times like this, businesses that are very well managed and have a good internal platform will fare better than the ones that don't have those things. And so again, this just is an opportunity to shine the light on those areas and figure out where you need to kind of polish up your business, whether it's with your management team, again, your labor, your supply chain, your customers, your ability to scale quickly, work remotely, your dependence on high fixed costs, bricks and mortar, things like that right now, where people are seeing if you were a much more variable cost based business and more nimble and able to adapt to something like this, you were in better shape than someone who had a lot of fixed costs, a lot of bricks and mortar, a lot of things that you were still having to pay for, even if your business was not operational at this time. So I think the diligence process will change in the future based on what we see come out of this pandemic. But it's a chance to look at your business, find your weak spots, and fix them before you take it to market.
Dale, you touched upon some of the hot and cold sectors earlier on, and I think even Kieran referenced, maybe if your business was more technology savvy, you might be more valuable in the future. Is there any sectors that you think could get hot in the current environment or really go cold?
Yeah, the obvious one is IT services, software, enterprise, SaaS, and cloud, right? So IT comprised about 22% of the first quarter 2020 deals in North America, and that's up 5% from the same period 2019. This is an indication that there's value there, that sophisticated buyers, whether they be PE firms or PE firms that own platform companies, understand and see the continued value. We're all attending this webinar from remote locations, and just one minor example of the value of technology. One can always look at the stock market and see what the FANGs and those things are doing. So it translates down to the lower middle market as well. The valuations in IT sector, for example, have held up and may even be enhanced as you go through 2020. Some other hot areas will be those that are related to, we'll say, select areas of healthcare. There are certain areas of healthcare that are going to experience a V-like recovery, as Steve was mentioning earlier, but with the different types of recoveries. And that'll be those that are tied to what we call elective surgeries. But it could be the person that has the really injured shoulder, et cetera, et cetera. And then there's all the supplies, et cetera, that support that effort. Those are examples. There are certain industries that will not be easy to recover, and those include obviously anything related to travel, leisure, that industry. The energy industry, as we all know, living in this region, is very important to this Western Pennsylvania economy. But the energy industry has been struggling for at least the last 6 months. And the unusual correlation, though, is that because of the decline in the oil industry and the price of oil, that's actually been a benefit for natural gas producers. The reason for that is simply that because of in North America, the majority of oil is produced in and around, we'll say, Texas, right? Oklahoma and Texas. When they produce oil, they have this byproduct called natural gas. So they were, in essence, giving away natural gas to get to the higher priced oil. They were, in some cases, paying people to take the natural gas away. So that depressed the national market for the price of natural gas. And so with the decline in oil production, there's less of that excess gas that's coming from the Texas area, from those regions. And therefore, the price of natural gas has recovered to the point where some of our local companies may have a chance to survive. But again, energy is probably an area that you'd have to be very, very select. There's also going to be, because a lot of the suppliers and the service providers to energy, there's going to be a lot of distressed deals in that industry just because of rig count is down, et cetera. So there's the areas that are hot are going to be few and far between. 2020 is not a period where, if the owner has flexibility, this is not going to be the period. 2020 is not going to be the period generally where you're going to maximize the purchase price for your business. Doesn't mean if you have to get it done, it cannot get done, but we need to recognize that because of the uncertainty in future earnings and this year's earnings related to COVID.
Dan, is there anything you can add to Dale's comments?
No, I think those are all spot on. The only thing I would add is, for example, I'd mentioned the aerospace. That was extremely hot industry coming into 2020, and right now it's extremely cold. You hear in the news that Boeing itself, could be worth 1% of the GDP, and that's had an impact before even COVID. You saw some impact on GDP because of the issues that Boeing has been having. Now with the airline industry in distress, the aerospace deals gone cold. We had done a couple of aerospace deals with high multiples prior to 2020, and a lot of groups, private equity funds and strategic buyers were looking for aerospace deals, and now that's a really cold sector. So that went from kind of boom to bust in a relatively short period of time.
But regarding the financing, Dale, and I believe it was you who touched upon this a little bit earlier, but could you kind of revisit that a little bit deeper as far as how this may impact the financing in relation to transactions?
Yeah, I think bankers are going to go back to being thoughtful, diligent bankers, right? The terms got relatively generous in 18 and 19. And we got to all remember that banks are regulated entities, and there's now going to be an increased emphasis on credit quality and on risk assessment. This is the black swan event that we all discussed when we were in college or in graduate school, but now we've lived through it. So the ability to forecast future cash flows for any of us on this call is less certain than it was in December of 2019. And so bankers will reflect that in how they assess risk and how they will underwrite deals. There's generally going to be less leverage allocated to acquisitions. Now, again, so we know that generally. Question is if you want an exact number, well, it depends upon the deal, and it depends upon the industry, and it depends upon a number of other factors, the strength of the private equity group supporting the deal. But generally speaking, bank debt is going to be less enthusiastic than it was in Q4 19.
So with that thought, we look to the future a little bit. Dan, what advice would you look for a company that maybe wasn't in the process, but looking to start the process in the near future?
Yeah, so it's very difficult to time the market in any economic environment. COVID just leads to more challenges. I think what you have to do is you need to assess the company's financial profile over the past and next several months to begin with. And if there's visibility and you haven't really been materially impacted by COVID, and the business owner still said, hey, I want to get this thing in the market. I want it done by the end of the year. I'm concerned about taxes maybe going up next year. Then you could probably put that company in the market. 2 clients in the position right now will be taken to market next month. They have not been impacted by COVID. They both still want to sell by the end of the year, and they have very good visibility in their cash flow with strong backlogs or pipeline. So we feel pretty confident in we could take those to market probably in the next couple months and have a good outcome for the business owner. Now, if we're reviewing a business and it's been severely impacted or does not have the visibility, then you're not going to take it to market. It's probably it's either not saleable at this time, or if you do take it to market, it's going to be at a severely low valuation. And unless the business owner absolutely has to sell it, then we would not advise taking it to the market. So you have to spend a lot of time really assessing the current situation, where they've been, where they are now, and do they really have visibility? Because it's been mentioned by others on the panel, people are valuing the company off the future cash flows. To the extent you can't prove to them what those are going to be or defend them, then that's going to severely impact value, or even whether a buyer will be interested in your business at all.
With that thought, Kieran, I know you touched upon it a little bit earlier, but could you dive in a little deeper, maybe what business owners can do to help the strength of their company?
Yeah, definitely. I think, as most of the panel said today, this is a time when I think industry really does matter more so than in the past. When you talk to a lot of private equity funds in the past, they'd say they're industry agnostic. There are certain industries now that are just so unattractive, people are going to stay away from them. So, for example, I'm talking to a couple clients over the last week, both in different situations, where one was a software as a service company. He was getting calls from strategic buyers prior to this, and he said the amount of calls he's gotten over the last 2 months has gone up. So he has more people chasing him to buy his business now than he did before. They're doing very well right now. They're in an industry, obviously, with tech that wasn't necessarily as affected. They were more affected in a positive manner. We have a large oil exploration company that is raising $300 million in capital to go after distressed midstream and upstream assets. So they're looking at it to take advantage of. So, one client in the software business, his business value has probably increased, and the deal flow in that area we will see go up. The other client, although they're doing well and raising money, they're raising money to take advantage of anyone who has to sell in kind of a distressed space in the area that they're looking at. So I do think that deals will get done, but they'll just be different than how they were before. Traditional cash flow deals, you might have to look at underlying collateral values and things like that. I think the real estate market is really taking a beating right now. So if you have a business that's very heavily tied to some real property, you might have to get creative with how you sell that business and structure the property. Again, I think, as always, what we try to tell buyers or sellers is you need to kind of address the skeletons in the closet, as I was saying earlier. Figure out what your blind spots were. Figure out ways to really strengthen your platform, your management team. One of the things that we didn't talk about, I didn't talk about during the diligence phase, is just what, from an EBITDA perspective, in terms of quality of earnings, what does the impact of a PPP loan do? I think you're going to have to look at that on a company by company basis, because people were taking these. Some people needed them dramatically. Some people needed them a little bit. And so I don't think it's fair to just say, hey, we're going to add back forgiveness. You're going to have to look at how it affected their entire cost structure. So as a business owner, understanding that and having a story to tell, I think that's the most important thing. Investors want to buy something based on potential future earnings, right? So if you can demonstrate what you've done to increase the value of your business in terms of strengthening all of those things so that you have the ability, once things turn around, to go out and grow your business, and you have a story to tell coming out of this, I think that's the best thing you can do to kind of improve, as a business owner, improve your company's value in the market.
How do you see the pipeline being impacted in the next 12 to 24 months?
You mean from a buyer perspective?
Yes, as a buyer, as someone who basically relies on you, maybe a PE firm that relies on you for deal flow. What are your thoughts of how the pipeline is going to be impacted in the next 12 to 24 months?
I think it's still going to be fairly okay. From a PE perspective, a lot of the private equity firms have kind of taken a pause to reassess the situation, but they are starting to tell us that for their portfolio companies, they are looking for small add-on acquisitions. So they're active in calling companies that they may have called on over the last several years and have not been able to really shake anything loose. And they're looking more aggressively at small add-on acquisitions. They're also contacting companies that they currently don't have a portfolio company in that industry, maybe for a platform type of company. So they're reaching out to companies they've also been contacting the last several years to re-engage, to see if it's something that timing's right, or if it's something that makes sense at this point, that they can move forward with potential acquisition. So I think quality companies are still going to be attractive because there's a lot of capital out there. It's just going to be more selective. And, business owners, when we talk to all the time, they're concerned about a number of things in the future. Higher taxes. Are we going to have higher taxes? Is capital gains tax rates going to go higher? Concerned about that. They're concerned about the election and whether which party wins. There's always concern about what happens after the election. And some of those business owners, they're saying, we haven't been impacted as much. We still want to put our company in the market because we're concerned about those factors. So I think deal flow in general is going to be lower, but I still think it's, because there's a lot of money out there, people are going to be more aggressive trying to find deals.
Dale, do you have a similar thought where the deal flow might be a little bit lower? And I guess in addition to that, do you have a guesstimate of when you think it might return?
Yeah, Joe. So I'll answer that in a couple of ways. Number one, the question says when, it focuses on an owner preparing to sell. Let's assume that for a variety of circumstances, they need to sell in 2020. It's just the right time in their life. There's some other issue. So and then your question is are there specific events or levels of economic activity that could help enhance that value, guide that decision? So in that regard, if they can generate or identify or communicate, present that volume has not declined, or if it's declined, here was our response and here's the way it's coming back, that's going to enhance their position in the marketplace. And in that regard, if they had a little loss in revenue, or if they had the spike, but we'll call it the V recovery, they can tell that story, identify that, then they will attract interest. Just as Dan was saying, there's an abundance of capital with sophisticated buyers, private equity groups and the like, that have raised money, need to deploy it. And then you'll begin the discussion and the negotiation process. So it's if the owner decides to sell, is preparing to sell, wants to go to market now for a variety of reasons, then the answer is then you want to address early on, you want to identify what the impact of COVID was. Here's how we've come out of it. Here's what we've done. And when people buy future earnings, when they buy companies, they're buying management teams, right? They're buying, so the COVID crisis is a way to demonstrate the quality of management, the quality of the company systems, the quality of middle management to execute in remote manners and et cetera, et cetera. So this could be a way the selling shareholder group could communicate the value of the enterprise, and it was put to the test. And therefore, That's why we should command a number of offers and strong offers. From a general perspective, 2020 is in essence going to be a bogey, right? It's going to be a gimme. So the question is coming out of 2020, how is the company positioned? What are the expectations? We're all going to live the next 6 to 9 months, and we're going to understand, does the virus come back with a vengeance in the fall? Is it a non-event? Is only these 3 industries are impacted, but these industries are not? And then by that time, then you'll have visibility into 2021. And again, because of the abundance of capital that Dan has mentioned, there is going to be demand for companies. So in a best case scenario, if you could choose your timing, I think you want to get through the crisis and allow sophisticated capital to get to the point where they say, okay, well, we can understand this forecast. And then going forward, then you'd be able to create value moving forward. So in an ideal world, if you were a seller, you wouldn't want to come to market right now, unless you just came through the COVID crisis because of your industry stronger than ever, then you might want to choose this time. But if you're in an industrial activity, if you're tied to the general economy, or if you're in a cyclical industry, then you're going to need to choose that in a more strategic and thoughtful manner.
So Dan, with in our conversations and preparing for this webinar, we received a question as far as a potential new type of business model. And I did clarify the question. And so what it dealt with was basically earnouts. I know in our conversations, when you took a company to market, you try to limit the earnouts as much as possible. But with the future that we have potentially going forward, those deals that did include earnouts, could they extend beyond a normal time frame? And could those earnouts actually be a little bit more complicated now with more strings attached?
Yeah, I think that's right. I mean, as you mentioned, in a hot M&A market, you can really limit the amount of earnouts, and because there's a lot of competition for deals, and you're trying to get everybody to pay the maximum price that they can without an earnout. We always looked at earnouts as, hey, if everyone else is at a certain level, but then there's one other group that will provide an earnout, that's just an added bonus on top of it. You have to be careful with earnouts because you have to really negotiate up front how they're going to be calculated and what time frame they're going to be earned over. So there needs to be a lot of upfront diligence on exactly that, because sellers are concerned that if they're getting an earnout as part of the transaction, that they don't, now that they sold the company and don't own it, they don't have control over it. Could a buyer come in, put a bunch of SG&A on for growth, and take the EBITDA down, therefore they don't hit the earnout? So there's a lot of negotiation that needs to go on to exactly calculate how the earnout is going to be computed. What we've done in the past is make it as simple as possible. It's some percentage of the revenue, or it's based on material margin. Something that's very quantifiable and doesn't include a lot of calculations. But I think because of the challenges that we have now with companies seeing reduced earnings, but feeling that that's going to come back, I think to bridge valuation gaps in certain cases, you're going to have an earnout in there. And maybe instead of a 2-year earnout, it's going to be a 3 or 4 year earnout. Maybe each year they can earn some portion of the earnout. But I think, because just the uncertainty and, I keep using this term, lack of visibility, if people want to get a deal done at a valuation that even makes any remotely sense to them, we're going to see, and there's going to be a need for earnouts, or in some cases, maybe they roll over some equity into the new deal and they get some additional upside through their rollover equity investment and some options, maybe to help bridge a valuation gap. So I think we're going to see more of that.
Keeping the process moving, because I know we're getting close on time. Dale, you've touched upon the distressed deals coming into play and the likely sectors. I would add to that question, was there any word of caution that you could provide in regard to pursuing distressed deals?
Distressed deals are fraught with risk, so everybody enters into them with caution, and diligence is high and the process is fraught with risk. So, but again, unfortunately, there's going to be a lot of companies pushed into bankruptcy, pushed into reorganization. And so there will be opportunities to acquire companies if some of your clients have a good, strong balance sheet and they want to maybe add somebody for they want to expand their product line or they want to expand their geographic presence, then acquisitions are a way to do that. And they may choose to do that. They may say, boy, we've known the Smith Company for the last 15 years, respect them. It's a shame what's happened to them. Let's have that conversation and let's see what we can get done. Because if you're an industry expert, if you're an industry specialist and you're in a certain industry, then you know the risk better than anybody else. And so those types of strategic acquisitions, those types of add-on acquisitions can and will make a lot of sense. There's a lot of qualified workout specialists. There's a lot of very specialized lawyers who work in this area. So they can limit risk, right? And you're always concerned about legacy risk. And there are ways to structure a transaction where it can be a really nice add-on at a really economic price. Now that's good if you're the buyer. That's less attractive if you're the seller.
This presentation focused on the third-party sale, but as Steve referenced, there are other options. And Steve, maybe you could provide some insight into alternative ways to begin exit planning that could benefit from the lower valuation, such as gifting the shares.
Sure. Thanks, Joe. So, the annual federal exclusion is $15,000 for 2019 and 2020. And from an estate planning perspective, clients, business owners can use that as a succession planning mechanism to, say, keep ownership in the family and maybe transfer some shares to a child or a relation who may not have had interest in continuing the business previously, but maybe now may have more interest if they are gifted some shares. So we are seeing some movement in the gifting mechanism, and that's certainly something to consider. I also mentioned some other options that may not be considered immediately, but should be considered, like the employee stock ownership plan or ESOP. And in terms of exit planning generally, it's never too early to begin searching for someone outside your organization that can come in and succeed you, or have an internal promotion to sort of ramp up the quality of that management team. Because as Dale and Dan have emphasized, quality of management is a really key element in any business sale, especially with a third-party financial or strategic buyer. And it never is going to hurt your business to have a really strong management and ownership team in place, helping guide your organization through this troubled time.
So that was the last of our pre-planned questions. During the conversation, we did receive one question via chat, and if anyone has a question, please feel free to forward those to me using the chat feature. Kieran, you did touch upon it briefly, but it did come after the question. Can you just go a little bit deeper into maybe how a business owner who wasn't looking to sell this year, but maybe looking to sell 2 or 3 years out, what they could do to prepare their company for a sale?
Sure. And I think this advice is the general advice, not pandemic specific, but as you never want to wake up and be forced into a transaction without having planned it out thoroughly. So spending the time, again, evaluating your business, evaluating your management team, understanding who the buyer would be. I think it's important for each company to understand their industry and who a specific buyer would be. Are they going to command a much better multiple selling to a strategic or a financial buyer? And then preparing your company along those lines, right? If you're going to sell to a financial buyer, they're going to back the management team. It's all about your management team. Whereas a strategic might be looking to acquire you because you have a product that they find complementary to their product suite, or you have a customer base that they feel would be advantageous for strategic purposes to acquire. So first is definitely trying to understand who would acquire your business, and then tailoring your business to capture the kind of data that you want to be able to tell the story. So whether that's, again, based on what the value drivers are in your business, right? So identifying those value drivers and then having platforms, processes, procedures to capture the right kind of data from those value drivers to be able to present that, whether that's customer margin data, whether that's sales history data. So building out the team is important in certain circumstances, building out your information and what you want to highlight as the value of your business, what are the main economic drivers. So again, understanding all of those things, who would buy the company, and then making sure that you're polishing them up and showing them in the best light, having a story, right? Even if your business has been flat for 10 years and you go to sell it, you want the buyer to understand, why would he want to buy a flat business? Maybe, hey, if I was 20 years younger and had an extra $5 million of capital, this is what I would do to grow the business. So you have to really show them the path of why this is a good business and where it can go in the future. And anything that you can do over the next 2 to 3 years to keep building that up and cleaning it up will eventually add more value to your business.
Perfect. With that, I'm going to turn it over to Kieran O'D once again to close out the session.
Well, thanks, Joe. And I'd like to thank all our panelists. It was nice to get a group much smarter than I was to present to our clients today and talk about the fears that people are having. So as was mentioned many times on today's webinar, hopefully we will get through this. The M&A market had been very robust. I can't imagine it's going to completely dry up, and let's hope this is a little blip. And once we get through to the other side, we see more of a return to normalcy. But take this opportunity to evaluate your business, do what you can to present it in the best light and shore up your operations. And let's hope we all have a better 2021. So thanks, everyone, and we'll see you next time.